Hello and welcome to Wealth Management Insights. I'm Monica Guerra, Head of U.S. Policy for Morgan Stanley Wealth Management, and I'm recording this audiocast on Tuesday, February 25th. President Trump's second term has started with a wave of executive orders. Unlike his first term, when executive branch activity slowly increased as the president navigated D.C. for the first time, his return to office has been accompanied by swift action. Trump has signed over 65 executive orders since Inauguration Day, the most of any president in his first 100 days. This shock and awe activity has sweeping implications across a variety of policy areas, and the sheer volume of orders has left investors wondering which policies could have the greatest economic and market impacts. In turn, to decipher actions coming from the White House, our policy team has created a framework comprised of 4 policy pillars to guide our consideration of Trump's rapid-fire policymaking. Our pillars are intended to highlight policies that may have notable consequences for the markets and the economy. The pillars are as follows: budget, debt, and deficit, defense and foreign policy, deregulation, and tariffs and trade. The broad focus of the pillars allows for flexibility to interpret investor concerns related to macroeconomic outcomes, as well as risks and opportunities within sectors and industries. Now let's consider Trump's recent tariff actions. Investors and markets have struggled to parse through the headlines and differentiate noise from action. We view Trump's use of tariffs as a negotiating tool that could result in real tariff risk along the way. Broadly, future tariff negotiations are likely to aim to achieve one or more of the following policy goals: promote U.S. industry protectionism, strengthen national security, increase trade fairness, and raise revenues for federal government operations. Here are a few of our key market insights regarding Trump's tariff policies. First, headline risk could contribute to interim market volatility. Equity market risk can be viewed using both geographic and sector-specific lenses. The White House is simultaneously proposing and enacting both country-specific and industry-level tariffs. Notable examples include the potential for a 60% tariff on China and a 25% tariff on Mexican and Canadian goods. We can see the market impact of country-specific tariffs by reviewing the Morgan Stanley Institutional Equity Division Tariff Risk Index, a basket of stocks with high sensitivity to increased tariffs on China and Mexico. Relative to the S&P 500, stocks exposed to tariffs on China and Mexico have sold off by about 15% since March 2024. Since Trump took office, the China-exposed stocks have fallen 2% and the Mexico-exposed stocks by 6%. Second, technology, materials, energy, and industrials in the U.S. may be the most exposed sectors to tariffs, compared to utilities and healthcare. Recent announcements of steel and aluminum tariffs caused related stocks to fall 2% on the news before rallying on global supply and demand dynamics. Third, consumer discretionary stocks could see dispersion in performance as investors reward companies with stronger pricing power. Finally, tariff risks reinforce our preference for services over consumer goods. Some services, such as software, cybersecurity, defense tech, and large-cap financials, may also benefit from other policy tailwinds. For a more in-depth discussion of Trump's tariff policies, including tariff drivers and economic impacts of a heightened tariff regime, check out our latest U.S. Policy Pulse report, Trump's Tariff Agenda. As always, thank you for listening. And for further information pertaining to U.S. public policy, please ask your Morgan Stanley financial advisor for copies of our most recent reports.